Inventories and cost of goods sold are significant items in the financial statements of many companies. Comparing the performance of these companies is challenging because of the allowable choices for valuing inventories. Differences in the choice of inventory valuation method can result in significantly different amounts being assigned to inventory and cost of goods sold. Financial statement analysis would be much easier if all companies used the same inventory valuation method, or if inventory price levels remain constant over time. If there were no inflation or deflation with respect to inventory cost, and thus unit costs were unchanged, the choice of inventory valuation method would be irrelevant. However, inventory price levels typically do change over time. In this video, we will discuss two different inventory valuation methods and their impact on financial statements. First in, first out, or FIFO, assumes that the inventory items purchased or manufactured first are sold first. The items remaining in the inventory are assumed to be those most recently purchased or manufactured. Last in, first out, or LIFO, which is allowed under the US GAAP but not allowed under IFRS, assumes that the inventory items purchased or manufactured most recently are sold first. The items remaining in the inventory are assumed to be the oldest items purchased or manufactured. In periods of rising inventory prices or inflation, the cost assigned to the units in the ending inventory are higher under FIFO as compared to LIFO. A firm that uses FIFO inventory valuation method will be selling older, cheaper inventory if the prices are rising, and hence will have a lower cost of goods sold as compared to a firm using LIFO inventory valuation method. So with rising prices, using FIFO inventory valuation method results in higher net income and lower value of inventory as compared to LIFO inventory valuation method. Conversely, in periods of declining inventory prices or deflation, the costs assigned to the units in the ending inventory using FIFO are lower as compared to LIFO. With declining prices, a firm that uses FIFO inventory valuation method will be selling newer, costly inventory and hence will have higher cost of goods sold as compared to the firm using LIFO inventory valuation method. So with declining prices, using FIFO inventory valuation method result in lower net income and a higher value of inventory as compared to LIFO inventory valuation method. In general, in periods of changing prices, ending inventory values determined using FIFO more closely reflect current cost as inventory is composed of recent inventory. Cost of goods sold determined under LIFO will reflect the current cost as the most recent inventory is sold first. In the past 3 videos, we saw how a firm can use accounting principles to bias the information presented in the financial statements. Try to identify any such activity for the firm you are analyzing for your final project. In addition, review the revenue and expense recognition criteria summarized in the documents in the Unit 2 folder. That folder also contains a document summarizing the general steps for evaluating the quality of the financial reports. Step 3 of the project will take a lot more time than previous 2 steps, as you'll be reviewing the details provided in the footnotes and MD&A sections of the annual report. Please do not delay in getting started on this step.